Hello, and welcome to Financial Market Insights for Traders. I'm Sophia, and today we're tackling a question that's becoming increasingly important for traders, investors, portfolio managers, and anyone trying to understand where Bitcoin fits into the modern financial system. The question is simple. Is Bitcoin a macro asset now? For years, Bitcoin was treated as a niche digital currency, a speculative investment, a technological experiment, or an alternative asset for investors comfortable with very high volatility. But the market has changed. Bitcoin is now much more deeply connected to institutional capital, regulated investment products, global liquidity, monetary policy, and investor risk appetite. That means we can no longer analyze Bitcoin only by looking at cryptocurrency-specific developments. We also need to look at the Federal Reserve, interest rates, inflation, Treasury yields, the US dollar, liquidity conditions, equity markets, and the broader global economy. And that raises a much more interesting question. Is Bitcoin becoming a genuine macro asset? My answer is that Bitcoin increasingly behaves like a macro-sensitive asset, although it's still different from traditional macro assets such as government bonds, currencies, commodities, and gold. So today we're going to unpack what that means, why it matters for traders, how Bitcoin responds to macroeconomic conditions, and what investors should think about when evaluating Bitcoin's role in portfolios. Let's get started. Bitcoin's evolution from a niche asset to a global market. To understand why this conversation matters, we first need to consider how dramatically Bitcoin's market has evolved. Bitcoin began as a decentralized digital currency designed to operate outside traditional financial institutions. Its early investment case was largely driven by technology enthusiasts, libertarians, early adopters, and investors willing to take significant risks. Today, the picture is very different. Bitcoin has become accessible through institutional investment products, including spot Bitcoin ETFs. It is discussed by asset managers, financial analysts, hedge funds, wealth managers, and institutional investors. That change in accessibility is important. When an asset becomes easier for institutional investors to own, it starts becoming part of a much broader asset allocation conversation. A portfolio manager can now look at Bitcoin alongside equities, fixed income, commodities, cash, and alternative investments. The question isn't necessarily, do I believe Bitcoin is the future of money? The question becomes, what happens to my portfolio if I allocate 1%, 2%, or 5% to Bitcoin? That's a completely different conversation. And it's one reason Bitcoin as a macro asset is becoming a serious topic for financial market participants. What exactly is a macro asset? Before going further, let's define what we mean by a macro asset. A macro asset is generally influenced by broad economic forces, rather than just individual company-specific events. Think about government bonds. Bond prices are influenced by interest rates, inflation expectations, central bank policy, government borrowing, and economic growth. Think about currencies. Currencies respond to interest rate differentials, economic conditions, capital flows, and monetary policy. Gold is influenced by real interest rates, inflation expectations, geopolitical uncertainty, currency movements, and demand for defensive assets. Oil responds to global economic activity, supply and demand, geopolitics, and energy policy. Bitcoin doesn't fit neatly into any of these categories, but increasingly, it responds to some of the same forces. That's the important point. Bitcoin doesn't have to behave exactly like gold or a government bond to be considered a macro-sensitive asset. Instead, what matters is that macroeconomic conditions can materially influence Bitcoin's valuation. The relationship between Bitcoin and interest rates. One of the most important macro variables for Bitcoin is interest rates. When central banks raise interest rates, the financial environment can become less supportive of speculative assets. Higher interest rates can make cash and government bonds more attractive. They can also increase borrowing costs and reduce the amount of capital investors are willing to allocate toward high-risk assets. Bitcoin can be particularly sensitive to this environment because it doesn't generate traditional interest income. When investors can earn relatively attractive returns from lower-risk assets, the opportunity cost of holding Bitcoin can increase. Now, the relationship isn't always straightforward. Bitcoin doesn't automatically fall whenever rates rise. Markets trade expectations, not just current numbers. Suppose investors believe that interest rates will remain high for a long period. Bitcoin might react negatively before the actual rate decision occurs. On the other hand, if markets expect rates to decline, Bitcoin could begin responding positively before a central bank actually cuts rates. So for traders, watching the central bank headline isn't enough. You need to watch expectations. Pay attention to inflation data. Watch employment reports. Monitor government bond yields. Follow central bank communication. And pay attention to how financial markets are pricing future interest rate decisions. All of these factors can influence the environment in which Bitcoin trades. Global liquidity and the Bitcoin macro asset thesis. Another major concept is liquidity. Liquidity essentially refers to the availability of capital within the financial system and the ease with which investors can deploy that capital. When liquidity is abundant, investors may be more comfortable taking risk. They may allocate more money toward equities, emerging markets, technology companies, commodities, and digital assets. Bitcoin can benefit from this environment. When liquidity tightens, however, investors can become more defensive. They may reduce leverage. They may raise cash. They may reduce exposure to volatile assets. Bitcoin can suffer during this process because it remains one of the more volatile major financial assets. This is why traders interested in the Bitcoin macro asset thesis should monitor liquidity conditions. Instead of asking only what's happening to Bitcoin, ask a broader question. What's happening to the amount of risk capital available across global markets? That question can provide valuable context. Is Bitcoin an inflation hedge? Now, let's address one of the most common arguments surrounding Bitcoin. Bitcoin has a maximum supply of 21 million coins. That predetermined supply is one reason Bitcoin is often described as digital scarcity. Some investors argue that Bitcoin could act as a hedge against monetary debasement because governments and central banks can expand the supply of traditional currencies, while Bitcoin's long-term issuance is governed by its protocol. It's an interesting argument, but we need to be careful. Bitcoin's historical performance doesn't establish it as a perfect inflation hedge. Bitcoin can experience major price declines, even when inflation is elevated. Why? Because inflation isn't the only variable affecting its price. Interest rates matter. Liquidity matters. Leverage matters. Risk appetite matters. The US dollar matters. Institutional flows matter. And investor sentiment matters. So while Bitcoin scarcity characteristics may appeal to investors concerned about inflation and currency debasement, traders shouldn't assume Bitcoin will automatically rise whenever inflation increases. The relationship is much more complicated. Bitcoin versus gold. This brings us naturally to the comparison between Bitcoin and gold. Both are scarce assets. Both are sometimes viewed as alternatives to traditional financial assets. Both can be discussed in the context of monetary uncertainty, but they are very different investments. Gold has thousands of years of history. Central banks hold gold. Gold has a well-established role in global reserves. Bitcoin is comparatively young. Bitcoin is also substantially more volatile. Gold generally doesn't experience the same magnitude of price swings that Bitcoin can experience. So when we call Bitcoin digital gold, we should understand that we're making a conceptual comparison rather than saying the two assets behave identically. Bitcoin may share some characteristics with gold, but its risk profile is very different. For a trader, that distinction matters enormously. Bitcoin and equity markets. Bitcoin's relationship with equities is another reason it increasingly belongs in macro discussions. There are periods when Bitcoin behaves like a risk-on asset. When investors are optimistic, financial conditions are supportive, and liquidity is abundant, capital can flow toward higher growth and higher risk assets. Bitcoin may participate in that move. During periods of market stress, however, Bitcoin can decline alongside equities. This raises an important question for investors. If Bitcoin becomes increasingly integrated into traditional financial markets, could its diversification benefits decline? Possibly. Correlation is not fixed. An asset can have low correlation with stocks during one period and much higher correlation during another. This means investors shouldn't assume that Bitcoin automatically diversifies a traditional portfolio simply because it's a digital asset. Evaluating Bitcoin's role in portfolios. This brings us to what I think is the most important part of today's discussion. Evaluating Bitcoin's role in portfolios. The question shouldn't simply be, will Bitcoin go up? A more useful question is, what role would Bitcoin play within my overall portfolio? For some investors, Bitcoin might represent a small satellite allocation. For others, it might be a larger alternative investment. And for some investors, the volatility may make Bitcoin unsuitable altogether. There are several factors to consider. First is risk tolerance. Bitcoin can experience substantial drawdowns. If a major decline would cause you to panic and sell at the worst possible time, your allocation may be too large. Second is investment horizon. Bitcoin's volatility can make short-term trading extremely difficult. A longer investment horizon may provide more opportunity to withstand periods of significant volatility, although it doesn't eliminate the risk of losses. Third is position size. This is incredibly important. A 1% Bitcoin allocation has a very different impact on a portfolio than a 30% allocation. Investors should think about Bitcoin exposure in the context of their entire financial position. Fourth is liquidity. Bitcoin trades around the clock, which can be attractive for active traders. But constant market access can also encourage overtrading. Just because you can trade Bitcoin at 3 in the morning doesn't mean you should. Fifth is rebalancing. If Bitcoin performs extremely well, its percentage of a portfolio can grow substantially. Without a disciplined approach, an allocation that started small can eventually become a much larger source of portfolio risk. The importance of the US dollar. Another variable worth watching is the US dollar. Bitcoin is traded globally, but its price is generally quoted in dollars. Changes in dollar strength can influence global financial conditions and investor behavior. A stronger dollar can sometimes coincide with tighter global financial conditions. A weaker dollar can sometimes occur alongside expectations of easier monetary policy or changes in global capital flows. Again, this isn't a simple relationship. Bitcoin can rise while the dollar strengthens. It can fall while the dollar weakens. But if you're building a macro framework for Bitcoin, the dollar should be somewhere on your dashboard. What should traders watch? If you're trying to understand Bitcoin from a macro perspective, I'd recommend building a dashboard rather than relying on one indicator. Start with interest rates. Look at central bank policy and expectations for future rate changes. Then look at real yields. Real yields can influence the attractiveness of risk assets and provide important context for Bitcoin. Next, watch inflation. Consumer inflation data can change expectations around monetary policy very quickly. Then monitor global liquidity. Is liquidity expanding or contracting? That's an important question for almost every risk asset. Watch the US dollar. Monitor equity markets. Pay attention to credit conditions. And, of course, watch Bitcoin-specific data. ETF flows can provide information about institutional demand. On-chain activity can provide insight into network usage and investor behavior. Exchange balances and long-term holder activity can also provide useful context. The goal isn't to find one magic indicator. There isn't one. The goal is to understand how several variables interact. Could Bitcoin become more important as a macro asset? I think this is where the future gets particularly interesting. As Bitcoin becomes more integrated into institutional portfolios, its connection to traditional markets could become stronger. Imagine a world where Bitcoin allocations are commonplace across wealth management portfolios. In that environment, Bitcoin flows could increasingly reflect broader portfolio decisions. If investors become more risk averse, they could reduce Bitcoin alongside other risk assets. If liquidity improves, they could increase exposure. If real yields fall, demand could change. If institutional products attract significant new capital, Bitcoin could respond to those flows. This doesn't necessarily mean Bitcoin will become less volatile. Instead, it means its volatility could increasingly be explained through both crypto-specific factors and traditional macroeconomic factors. Bitcoin would still have unique characteristics. Its decentralized architecture matters. Its fixed supply matters. Its network adoption matters. Regulatory developments matter. But the macroeconomic environment would become another major part of the Bitcoin investment equation. So, is Bitcoin a macro asset now? Let's bring everything together. Is Bitcoin a macro asset now? I would say that Bitcoin is increasingly an emerging macro sensitive asset. It doesn't behave exactly like a government bond. It doesn't behave exactly like gold. It isn't a conventional currency. And it isn't simply another technology stock. Bitcoin is its own asset class, but its increasing sensitivity to interest rates, liquidity, inflation expectations, the US dollar, institutional flows, and investor risk appetite means that macroeconomic analysis is becoming increasingly important when trading or investing in Bitcoin. That's the key takeaway. If you're trading Bitcoin, don't look at Bitcoin in isolation. Look at the environment surrounding Bitcoin. What are central banks doing? Where are interest rates heading? What are real yields doing? Is liquidity expanding? Is the dollar strengthening? Are investors taking more or less risk? Are institutional flows increasing or decreasing? Those questions can help put Bitcoin's price movements into context. And for long-term investors, evaluating Bitcoin's role in portfolios should involve much more than forecasting a future Bitcoin price. It should involve understanding volatility, position sizing, diversification, risk tolerance, investment horizon, and the economic environment. Final thoughts. Bitcoin has come a long way from its origins as a niche digital experiment. Today, it is increasingly part of the global investment conversation. The rise of institutional participation and regulated investment products has made Bitcoin more accessible to traditional investors, while its growing relationship with liquidity, monetary policy, and risk appetite has made macro analysis more relevant than ever. But don't make the mistake of assuming Bitcoin has become just another traditional asset. Its unique characteristics still matter. Its volatility matters. Its technological foundation matters. Its limited supply matters. Its regulatory environment matters. And its investor base remains different from that of many conventional assets. The most useful way to think about Bitcoin today is perhaps as an asset sitting at the intersection of digital finance and global macroeconomics. That intersection is likely to become increasingly important. I'm Sophia, and you've been listening to Financial Market Insights for Traders. If you're looking for a world-class, cutting-edge, user-friendly trading platform app to monitor financial markets and put your market ideas into practice, check out the Crystal Ball Markets trading platform at crystalballmarkets.com/platform. Visit Crystal Ball Markets today and explore a modern trading platform built for today's financial markets. And if you're still building your knowledge of trading, investing, and macroeconomics, make sure you check out the Crystal Ball Markets podcast at rss.com/podcast/Crystal Ball Markets. It's designed to provide beginner-friendly trading, investing, macro, and financial markets podcasts, making complex market concepts easier to understand and helping you develop a stronger foundation in financial market analysis. Listen to Crystal Ball Markets and continue your journey into trading, investing in global macro markets. Thanks for listening to Financial Market Insights for Traders. I'm Sophia. Until next time, stay curious, stay disciplined, and remember, understanding the market isn't just about knowing where an asset is trading today. It's about understanding the economic forces that could determine where it goes next.